You may get a little excited when you shop at Burlington.
What a low price! You see that? They have my favorite brand! It's like a whole new Burlington! I can buy two!
I'm saving so much! Yeah!
Burlington saves you up to 60% off other retailers' prices every day. Will it be the low prices or the great brands? You'll love the deals. You'll love Burlington. I told you so.
Reality radio for a really great future. We're talking real money.
I am so sorry. I am just so sorry. I want to express my condolences to all of you who have suffered through the dramatic, the horrific stock market that we have experienced lately. I mean to tell you, if you invested in the S&P 500 over the past year, you're only up 10%. That's it. You're just up 10% over the past year. What a horrible situation we've found ourselves in lately. Do you think maybe you're overreacting a little bit? We're up 10% for the past 12 months for the S&P 500 at least.
Okay, but that's not as dramatic as saying, as CNBC said, the worst week since 2023. By the way,
it's a 10% year. 2023? Was that a bad year? That wasn't a bad year.
Not. The market made money in 2023. Or Bloomberg that says it's always a bad time for a market sell-off. Well, unless you're buying stocks, like most people are in their 401ks, that's not a bad time. It's actually a good time.
If you're young, you love periods of falling prices. And here's the thing we all need to understand. And by the way, welcome to Talking Real Money. The radio show, the podcast, the all-purpose program to help you better handle your pecuniary problems. That means money. Here's the thing we forget, okay? The stock market has, when measured by the S&P 500, has returned about 10% per year, every year on average, 10% per year on average, over a mere 100 years or so, roughly. So far in the last 12 months, it's done its historical norm, even with a big fat decline in there. Now, that's what you need to understand. Declines, folks, are the price you pay for those impressive returns.
Yeah, you got to accept the volatility to make more rather than putting it in a bank, a big bank, and making 0.1, putting it in a high yield savings account, again, completely safe, making, a little over 4%, putting it in fixed income. You mentioned 100 years of bond, somewhere around 5%. So accepting that additional volatility is paid off. But I absolutely hate these atrocious articles that get people so nervous. They call the S&P 500 nosedive this week. They talk about baby boomers. Bloomberg does, saying this drives much of the cohort is already in the early years of retirement, which kind of hurt my feelings, or preparing to leave the workforce. Now, here's the part to listen to. It's likely their portfolio would never fully recover. Well, is every baby boomer going to die in the next 3 months or something? I mean, it's 100 days. It's how long an average correction goes on.
The market correction is going to kill us all. We're all going to stress out, and our hearts are exploding.
But you gave some numbers. Let's give a couple more here because it's fascinating.
10% over a year.
And let's give year to date because people suffer from recency bias, right? The S&P 500 is down a whopping 4.4%. That said, we have been asking you for years, decades, in fact, to be globally invested. Had you done that, even if you're 100% portfolio, you're down 1.7%. And if you're 60% in stocks and 40% in fixed income, you're down a whopping 0.74%, less than 1%. Can you take it?
Now, just to clarify, these are globally diversified, value and small overweighted portfolios, correct? You got these from
and you own things like international
DFA,
value stocks. Yeah, international value stocks that are up 11.8%, international small cap value up 7%. And you get the picture, right? That other things don't always go up and down with the Standard & Poor's 500.
As a matter of fact, if we just say, we'll say things as simple as going to the Vanguard Total Market Index, Total World Stock, VT, right? VT, year to date, 0.01% loss.
Wow. That's struggle to get through that. That's
year
really
to date.
tough, I tell you.
Yeah.
It's the headlines that scare you. The reality should not. That's the fact.
Right. Quit paying attention. Paying attention and then reacting emotionally are the surest ways to destroy your portfolio. They do it more than any market can do over a long period of time. 855-935-TALK. Give us a call.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Well, you need some help keeping your discipline, maintaining your long-term perspective, or just trying to figure out how some of this stuff works so that you can enjoy a better future, a better retirement. Call us on Saturdays at 855-935-TALK, 855-935-8255. 8255. I'm Don McDonald. Tom Cock is back in the laundry room. I know you guys are happy that he's back home again. That fresh linen scent is the fresh linen scent combined with the smell of bulk dog food and dog treats is nothing to shake a stick at. 855-935-TALK is our phone number, so give us a call. And Patty, you're up. Welcome to Talking Real Money.
Hi.
Hi, Patty.
Are you there?
I am. So's Tom.
We are.
He's in the laundry room. If you want to bring your load by, just he's still got a couple hours to do it for you.
Free dog biscuit to the first person who shows up. So
I think I'll pass.
Oh, she's passing, Tom.
Okay. You're
free
smarter
laundry
than I am.
and dog treats. Jeez.
Okay.
All right, Patty. What do you want? What else do you want?
Well, I am 70 years old, and in past podcasts, I've heard you say that you shouldn't hold bonds in your Roth IRA. I have a traditional and a Roth IRA, and they're pretty evenly split. And so if I want my portfolio to have a 50-50 split, then that would mean I'd have all bonds in my traditional and all stocks in my Roth. And I just was curious if you could give me some more information. Is that the right way to go, or?
That's such a great question, and you answered it yourself. You're going to get 2 dog treats now, not just 1, but 2. I think you've earned it. So well done. Yes, is the short answer. That's exactly what I would do. Yeah, sure. Why not? I mean,
because remember, your portfolio is one thing. It is all of your accounts in aggregate. That's your portfolio. These are just parts of your portfolio. So how they're invested internally is irrelevant as long as the entire portfolio is invested properly.
And let's go back to why we suggest having the riskier things in Roth IRAs. Remember, Roth IRAs get tax-free treatment. All that growth grows tax-free, and then when you take it out, no taxation, as opposed to the IRA, which does grow tax-deferred, but when you take it out, you pay regular income tax on it. So, yeah, I think a 50-50. I mean, the challenge you're going to face, of course, is that the Roth will grow faster if history is a guide to the future. And then you're going to be starting to get like 55, 45. Exactly. We don't know. Might rhyme, might not predict, but that part you're sort of be starting to outweight it. That could be an issue, but I wouldn't worry about that for a little bit. And I like the advice of half and half. Makes total sense.
And it could be all in bonds in the Roth and all in stocks all in stocks in the Roth and all in bonds in the regular. So that's not a problem.
All right. But what happens, I haven't really started using my retirement accounts yet. Mm-hmm. I've been able to defer that. As I start drawing from my traditional IRA, I'm obviously going to get out of balance. At what point do I start putting bonds into my Roth because I'm no longer at a 50-50 split?
Well, that's what Tom was getting to. That's what he alluded to there at the end, is that eventually you're going to, you might get out of balance, and then that's a bridge we'll cross later. But remember, when you take the money out, because of the RMD, the required minimum distributions at 73, you will, if you don't spend it all, you will want to put that into bonds in a regular taxable brokerage account so that you're going to still keep some of that money in bonds.
So what I don't spend will go into bonds.
Go back into bonds, right. Go back into fixed income.
In a brokerage account.
Yes,
and
ma'am.
then if I get too out of balance
then eventually you throw some bonds in your Roth.
Yep. If you
Okay.
have to, then
All
you
right.
do it.
Thank
But
you
I think
very
this is a
much.
great place to
Appreciate
start. No, thank you. Great question.
Thanks,
Started off,
Patty.
so.
We appreciate you being there. The laundry room offer stands, though, for any of you close enough to Duval, Washington.
There's no one close.
Is the
to
machine
Duval,
running?
Washington.
Is the machine?
It's not today.
It's empty right now?
Managed to complete the spin cycle prior
see?
to the program.
It's available
Thank
to
you,
you.
though.
855-935-TALK. Call us. Let's go to Cleveland, Ohio. And Evan, welcome to our show.
Hey, how you doing?
Good. Thanks, Evan.
Hello. Hey, good. So I have kind of a general question. I'm pretty new to investing, and against my better judgment, I've been listening to this guy named Dave Ramsey. I don't know if you're familiar with him.
A little familiar, yeah.
Yeah, we know Dave and his work. Indeed.
Yes, we do. And by the way, I give Dave a hard time about his investing advice, but I think that the advice, the tough love he gives people about debt is very valuable.
Sure. Well, he made it. I follow him on social media. He made a very general statement, basically stating if between the ages of 25 and 65, if you invest $100 a month into some account, you should be a millionaire by 65. And so I was just wondering if you had a little bit more insight on that.
Wait, how much a month? $100 a month?
So that's $100 a month. That's $1,200 a year.
Hold on, I'll do the math. How many years? 40 years?
40. Yeah.
40 years, and we're adding.
Now, is this Dave's super secret account where he makes 12%
No, this is
a year?
this is his 12% a year American
well,
funds account.
that's
Yeah,
a
I'm sure.
Small problem with that.
I'm
but,
sure. Let's see what the based on 10, which is a historical.
Rather than the 12, the mystical, magical 12 Dave manages to come up with.
I don't understand. So we do 100. Why is this not
100 a month, 1,200 a year, 40 years at, let's say, 10%.
I must have put a number in wrong, so we're going to put that
I think
in.
Dave did as well, by the way, when he said that, but we'll find out.
Yeah, my compound calculator's not working, but my guess is, unless you get to 12, that little is not likely. I'm going to, you know what? I was in the wrong field on my calculator. I think I messed up. I think it was my fault. Yes, it was. What?
Don, the compounding interest is one of the quiz questions people face when it comes to financial literacy.
I know what it is.
Okay.
I know what compounding interest is. I just did the calculator wrong.
All right, just checking.
I was not exactly
sure.
I was not exactly a math whiz in school. I don't know how I ended up in the financial talk business, but what is
God
wrong
help
with
us.
me?
Let's see. I'm doing the same thing while you're doing it. 40 years.
40 years, $100 a month.
Say 10%.
At 10, we're going to just give it the market rate. I'm almost done. I just had it in the wrong thing. No, just shy, 900,000 at 10%.
That's weird because this calculator says 535,000. So
really?
Yeah.
At 10%?
Yep.
And you're adding 100?
Yep.
Oh, no, I'm sorry. Yeah, it's 637. 637.
Yeah.
100's to start, 100 a month. So what he's doing, I guarantee he's using 12. I guarantee he's using 12. I'm just going to pop 12 in. And he's...
We don't trust that number because we can't find it.
Right.
I'd hire the guy if I could, by the way, because why not?
Well, he's quoting, I think it's Investment Company of America. Yeah, I get, wrong rate. I got to put the 12 in.
Well, I could do the same while you're
Why
resting,
is this thing being so glitchy? Oh, trying to make me crazy. Okay, yeah, 12% is $1.1 million. Yep, that's where he's getting it. And I'm pretty sure he's using Investment Company of America because it's the only American fund that's been around that long. And, I'm going to go back and look at that during the break and see what Investment Company of America has actually done. We'll be right back.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-8255 is our phone number, 855-935-TALK. I'm trying to find American funds. Actually, it's only been around, it looks like it started in 1934.
Wow.
So
it's going
been
back.
pretty close. But even now Morningstar does not give the return since inception. And it looks like American funds does not either. But it is possible that Investment Company of America returned 12% per year over that time. It's possible because it was one of the early funds in the business. But the reality is that would be a ridiculous expectation. And one of the problems I have with Dave's advice is the fact that he states that the 12%, let's assume it existed. Let's just give them the benefit of that doubt. To assume that going forward as what he often says is a safe return expectation is, I think, horribly misleading. We don't even say 10. We don't even say 10%.
I usually
is a
run
reasonable
things at
expectation.
7. I think most
maybe,
people,
yeah.
It's so idiosyncratic, as we discussed once recently on a podcast, because when the money goes in, when it comes out, all those time periods can make the difference of returns. Can I ask another question about American funds?
Yeah, I love questions about American
well,
funds.
because this one just came in yesterday from Ryan in beautiful Monroe, Washington. My broker from American Funds, and he said, I know, I opened a Roth there when I didn't know any better and never rolled out of it, is now saying that mutual funds outperform index funds in downturns. Is there any truth to this?
What funds?
Mutual funds outperform index funds in downturns.
Oh, he must
in other
mean
words,
active.
Like American funds, do they do better in downturns than just owning an index fund?
Well, now there has been some evidence that shows in aggregate, there was a University of Pennsylvania study that showed in aggregate during down markets, the actively managed category where they're trying to be in it, they're trying to be out of the market at the right time, and did actually by about 1.5 percentage points outperform during down markets. But even this study threw out the caveat, but they don't during up markets. And the difference is pretty substantial.
Well, remember, up markets make up about 3/4 of the time in the market, depending on the period you're looking at. So you win,
if you stay with active, you would have won 1/4 of the time and lost 3/4 of the time.
That's like my football team. I don't want to do that.
I won't even mention their name.
I appreciate that. Painful as it is.
But the reality is, it's like trying to, let's say right now, a lot of people, I've heard this from a lot of people, that the stock market is going to go down now. It's just going to go down.
It has to.
Has to.
Yeah.
Everybody knows that. So why don't I get out right now and then get back in later?
Wait the 114 days, the average correction. That's how long it goes on. And then to basically 3 months, get back in the summer sometime. Sure.
Yeah, except there's very little evidence that anybody actually does that.
Well, I think recent history is proven. I mean, let's go back to the election of Donald Trump. Great piece in the Wall Street Journal this week talking about how people said, this is going to be great. I mean, the market went up, right? And the president's always said, oh, I look at that market and that's my report card. The unexpected things that he's done.
Is it really?
Yeah, exactly. And
can't be feeling too good about his grade for this semester.
This is so indicative of what people say has to happen and then in no way does happen. And you pay a price for believing the future is going to look like what you think it will be because nobody knows what the future is going to. Sadly,
and one thing we can tell you, and this is not scientific, it's just lived experience, it's anecdotal by definition, but both of us were doing podcasts in 2008 and 2009.
Oh, yeah. Before then.
But I'm saying during that period.
Yep.
And do you recall anybody in early 2009, January, February of 2009 going, this is it, I'm getting back in, I feel so good about stocks?
No,
after they'd gone down 50%.
I was still buying, by the way, every 2 weeks.
Well, because you were dollar cost averaging. By the way, I found the number. American Funds Investment Company of America Class A. Lifetime return since 1934. Average annual 12% per year.
There you go. Dave is right again. Shut up, Tom and Don.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
And it's curious. I was, during the break, I was looking back at the history of the American Funds Investment Company of America, one of the oldest funds in the country. And here's the problem. That 12% return that they have, in fact, posted since 1934.
Remarkable.
It's a very good return. A lot of it came about in the early years. There was a lot of, for example, in 1935, that fund returned 83%, while the S&P, or the equivalent of the S&P, returned 47%. So they had some big years early on. And here's the other thing that Dave doesn't mention, and this is what we try to emphasize all the time. You always need to not just accentuate the positive, you need to accentuate the negative.
And
when it comes to
realize
investing.
it's coming. Yeah.
Because we know it has come. In 1930, right after that big 83% return, in 1937, American funds lost over 38% in 1 year.
Which, by the way, we know most people cannot take that kind of loss.
No,
they won't stay.
And back to back in 1973 and 1974, American funds lost 33% over that period, and in 2008 it lost 35%. So you're going to have big declines, and we know, because of our experience and the experience of Nobel Prize winners who've researched this, that investors do not behave well in rapidly declining markets, which is why we're not telling you to buy or sell or get into this or get into that. We're telling you to make sure that your portfolio reflects your risk profile. Make sure it's the right portfolio for bad markets.
And we can help you understand that by going to talkingrealmoney.com and clicking on Risk Quiz. You can take a quiz there that will help you.
And that's going to give you your risk tolerance. That's going to give you your risk tolerance, and then you need to kind of fit that in with your risk need, because, as we also say a lot, you may not need to be 100% in stocks if you've saved consistently. You don't need to do that. It's not necessary. Don't do what is unnecessary. Don't take unnecessary risk.
I say that all the time here in the laundry room, by the way. I'm right there with you.
You don't ever get inside that washer or dryer. I know it's tempting.
I wish
you see
I
that
could.
door and
They're
you go,
big.
I wish I could fit. They're huge. Even you could fit in there.
Huge. I think I could, actually.
Put the dog in for a little tumble. Anyway, give us a call, 855-935-TALK, 855-935-8255, because we love talking with you about money. But you can also send us questions at talkingrealmoney.com, and Tom has about 33,000 of those sitting in the laundry room.
A lot of questions, so let's see if we can get to a few of them.
Got a full laundry basket full of them.
They're popping out. Sabanya, I believe I have that right. If I assassinated your name, I apologize, from Las Vegas, writes, I'm almost 48, trying to figure out what to do with an old employee retirement plan from when I worked in county government for just a few years. Then, Sabanya added, I also have my father, his wife, and sister living with me, and I'd like to plan for my future and find out if I can claim them as dependents. They're all receiving Social Security benefits.
You could charge them rent.
Yeah.
The way it works is you have to be covering more than 50% of their cost of living.
So you'd have to be paying like the house mortgage.
Which, well, it sounds like, you'd have to sit down and figure it out. And I would sit down with an accountant and figure that out to make sure you get it right so you don't get in trouble. Although there will be no one left at the IRS to yell at you in the future. It's just like, hello,
send it in and wait till 2027 when they respond. It says the other retirement account's worth about $45,000. What would I do with this? Yes, I would probably move it to an IRA, better control. Yeah. And and invest it according to what we just talked about, how much money you need to make on that, how much volatility you're willing to accept, and what your overall emotional makeup is with money. Try to do it that way, and yeah, I'd probably get it out of the government plan.
Yeah, because it's likely you're going to get a better plan anyway. And if you're not going, back to work for them, there's no advantage to having that. Usually these 457 plans, they tend to skew heavily towards annuities.
Sadly, yes.
Sadly. But yeah, it's all about risk profile. Let me just again tell you what goes into your risk profile. Need for risk and tolerance of risk. You can find out your tolerance for risk. Go take, at least you get a good idea. Go take the risk quiz at talkingrealmoney.com.
Tom and Don are talking real money.
Ready for your next adventure? KLM Royal Dutch Airlines brings you Real Deal Days. Your chance to uncover real adventures and create real memories. Taste the real Amsterdam, explore the real Barcelona, and discover the real Johannesburg, along with many more destinations around the world. Secure your real deal today and seize the moment with KLM Royal Dutch Airlines. Restrictions apply. See terms and conditions at klm.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Hey, everybody. Don McDonald here in Florida in an actual studio. Tom Cock in Duval, Washington in an actual laundry room.
This is the most popular.
No AI laundry room. This is a real one.
Yeah, this is the most well-known laundry room in Duval because, there's no dry cleaning in Duval either. There's no place to drop your shirts off.
Oh, come on. There's got to be a dry
I'm thinking I'm going to start that. Do that on, my spare hours. Sure. Why not?
Yeah, you could put a little press in there. You'd be fine.
The house is a little out of the way, but you come by, you drop them off. There you are. So
855-935-TALK is our number. Yeah, and in the summer, you can swim in the lake.
You could
Don't do it now.
While you're there. I just looked this morning. You know what the lake temperature is? I checked it this morning.
It's in its 40s, I'm sure.
Yeah, 43. So a bit chilly.
Oh, jeez. All right, let's go to Spokane, Washington. Jack, you're up. Welcome to our show.
Hey, thanks, guys. I appreciate your help. I'm kind of wanting some help on understanding some of the terms that are used around investments. So for in stocks, they use terms like large cap, mid cap, and small cap. And they also talk about growth stocks and value stocks or value funds. Are these industry standard definitions so that when I compare, like a large cap growth fund under Fidelity to a large cap growth fund someplace else, that they're using the same definition?
When it comes to large, mid, and small, there are standardized definitions. When it comes to value and growth, they're a little bit, a little more squiggly, a little more squishy, because value is a measure. There is a basic standard, and it's based on the book value of a company versus its market value.
Yeah, let's break that down so people understand. The book value would be if you went to Microsoft, for example, to the campus not far away from here in Redmond, and you looked at all the buildings they had and the goodwill and all the stuff that makes up the accountants are going to add that all up and say, here's kind of how much the company's worth, okay? You compare that then to what the shareholders in the company say it's worth. And right now, the share value is far higher than even with all the buildings they got in Redmond, et cetera, far greater than the value of all the things that they own. Therefore, it is what we'd call a growth company, and the other
means
ones,
the
right?
price. The price the price is based on the potential growth of earnings as opposed to the value, the fundamental value of the company's assets and goodwill and intellectual property.
But back to your previous question about large cap, mid cap, small cap, et cetera. That refers to the cost, the number of shares outstanding times the share price. That's a number, right? Some of these things are now in the trillions, right? You've got Microsoft, Amazon, Tesla, these huge companies they are large cap. Actually, in some ways, they call them mega cap companies. Conversely, there's little companies that you don't know that have a lot of shares outstanding, but the share price is very low. So they're small caps. And then the people in between. I think the breaking line right now for small caps to mid is around 10 billion, if I have it right. Somewhere in that area. And then isn't that right? Isn't it 10 bill?
No, a small cap, again, this is the number I have. Small cap is 250 to 2 billion. Mid cap is
2 billion. Okay.
Yeah, mid cap is 2 to 10. Mid cap is 2 to 10. Large cap is 10 plus, although, as you mentioned, there's now mega cap definition, and I believe mega cap is 200 billion. So, and by the way, we have another one at the small end, and that's the not small cap, it's micro cap.
Yeah, which is,
and they are defined, although those definitions are subject to change with changes in inflation and market values. But right now, so technically over 10 billion is a large cap company, 10 billion in value of all the stock.
10 billion, yeah. So, and here's the things I think you should pay attention to, Jack. Number one, you want to own kind of all of them. You want to have the large cap and mid cap and small cap, and you want to own growth and value, because what you hear oftentimes is, well, now it's all about large cap stocks, which it was for a long time. And then look what's happened this year. Things international small, some of those other places have gone up while the large caps have gone down. No one knows the future for any particular, what they would call asset class. That would be, like, as you said, large cap growth stocks or large cap value stocks. So you really want to own a portfolio that has all of them. But your question is an excellent one. I hate the fact that we use jargon all the time. I try to stop it myself whenever I possibly
but boy, to
can.
try to explain it to every time we use it would be, because value, I can tell you, value and growth become very tricky because they use a number of different financial ratios. Even the dividend yield gets thrown into the calculation of a stock's value and whether it's undervalued or overvalued. And again, those definitions are relative to the situation with the stock market in general. So it's an art. I have to tell you, though, I do know for a fact that dimensional funds and Avantis funds, those kinds who want to overweight small in value, they have rules. They have a calculation, and they say, based on this calculation, a stock is a value stock.
Okay. Well, what about bonds? I've heard you say that you don't recommend long-term bonds because you're not compensated for the risk you're taking or something like that.
That's correct.
What are the definitions on bond? There's short-term, mid-term, long-term.
Short, intermediate, and long.
Standard definitions for those? Short-term, intermediate, and long. Are there definitions for those?
Short term tends to be
anything longer than 10, I believe, would be long, for one thing.
Anything over 10 is long, and I believe it's about
intermediate
2 to 5.
Would be 3 to
5. Yeah, maybe 3 to 5 for intermediate. Let me look it up because I haven't looked that up in a while.
And then when you're also thinking about bonds, you also want to talk about the quality, right? How they're rated. Is it AAA? Is it
investment
BBB?
grade or junk?
Yeah, exactly. So you want to know that as well, because. And then actually what it's paying, the coupon rate, the interest rate on those too. So those are ways to evaluate them. We believe, and you correctly said it, don't take risk with your bonds, take risk with your stock. So safer bonds have been the better play for balancing out the risk you're taking with stocks.
Right, because we don't look at bonds as a means by which to generate income. We look at them as a way to improve stability, and short to intermediate term bonds tend to be more stable because they mature more quickly. A short-term bond is 1 to 3 or under 3 years. Intermediate is 4 to 10, and long-term is 10 plus.
And how does the Argentinian 99-year bond? Where does that fit in?
That's a are you out of your mind bond?
Yeah, but it's still paying 17.8%. So
it's a loony bond. That's a Looney Tunes bond. Not to be confused with Canadian currency. It's a different kind of loony.
Ooh, let's not go there today. Does that help, Jack?
But based on it helps a lot. Based on your recommendations about long-term bonds, should I avoid like BND because it's owning all the bonds, so it's got to have some long-term bonds in it?
Yep. It does.
Well, yeah. Should you
Not
avoid
many,
it?
though.
No, because here's the reason. Because they have so many bonds that you've got a lot of the shorts and intermediates that are coming due soon enough to give you a little bit. It's posted a relatively high degree of stability. But if you want higher stability, then you stick with short intermediate bond funds and skip BND. Thanks for the call. We'll be back.
Tom and Don are talking real money.
This episode is brought to you by Shopify. Upgrade your business with Shopify, home of the #1 checkout on the planet. Shop Pay boosts conversions up to 50%, meaning fewer carts going abandoned and more sales going cha-ching. So if you're into growing your business, get a commerce platform that's ready to sell wherever your customers are. Visit Shopify.com to upgrade your selling today.
For your real life and real future, Tom and Don are talking real money.
The nice thing about the Vanguard bond index or any bond index like BND is the fact that it reflects the bond market. And therefore, its percentage of assets in the long-term category, which is the 10 plus years, is actually pretty low. It's
How big?
Less than 20% of the portfolio.
Yeah, and most of it's pretty safer. I mean, it's mostly government, right? 60% government.
The bulk of the portfolio, almost about 30%, is 1 to 3 years.
And government versus corporate?
It's 50% government and 50% corporate. But the corporate, remember, these are investment grade corporates. So 71% of the portfolio is AAA rated or better. So,
in Vanguard with bonds, they've really done a pretty good job for a very long period of time. That's no guarantee of the future, but I like the work they've done. It's inexpensive and it's well balanced, I think.
But it did suffer a pretty substantial loss in 2022.
Don't tell me.
It was pretty big.
Let's see. I'll say 13%.
Dead on, 13.11. 13.
You're good. You're good.
1.
Last week I got out on the road. Did you know this? Maybe you did. Maybe you did. I spoke to a group of realtors.
Last week was really weird. Oh yes, I do know that you spoke to the real estate agents. Sorry,
real
realtors
estate agents. Thank you.
Realtors is a trademark, so you have to say trademark. National Board of Realtors.
But I loved it. It was fun. The interaction. We used to do that a lot, right? We used to do a lot of classes.
You loved doing those.
I know. I like talking to people. So here's the thing. I'll do it again. Not to the same group again, but I'll do it again.
For punishment. I'll do it again.
So if you want two things to mention here, if you would like me to come speak to your group, go to talkingrealmoney.com, click on Meet an Advisor. Tell them, love to have Tom come speak to our group. I'll do it. I like to have fun doing it.
Or just drive by the laundry room in Duval and
throw something.
Yeah.
Number 2, I still have one slot left to meet with people on Monday, April 14th in Arizona. So if you're listening in Seattle right now and you want to go to Arizona because you want to get out of this, which is really ugly, but I have one slot left in Scottsdale.
Check the temperature in Florida.
Yeah, I know it's
85
rather
degrees and sunny.
And it's like pouring rain and 40 something here. So all kidding aside, go to talkingrealmoney.com, click on Meet an Advisor and say, I want to meet with Tom in the desert on the 14th because I have one meeting time left. Love to meet you. How's that?
You're gonna be wandering the desert with Tom for 40 days and 40 nights
with a little bit of
very
water
seasonal.
In it, so.
It's a very seasonal sort of theme.
This is seasonal theme.
Passover. Anyway, what else was I going to tell people? Questions. We have 3 ways to ask us questions because our goal is to answer your questions. And you can do it one of 3 ways. You can call us, like during the show, like we're doing right now, at 855-935-TALK, 855-935-8255. Or you can go to talkingrealmoney.com. Up in the upper right corner, it says Contact Us. Click that. And then you can type out your question, and they go into Tom's giant basket there full of paper.
Oh, yeah, these. Sure. Yeah.
Do you know, Tom, those are actually on your phone, your computer, and your iPad.
No idea how to do that.
You could do that without having paper. You could actually.
But then what would we do with all these nice trees I'm cutting down? So there you go.
Good point. They need to serve some purpose. Or my favorite way for you to do it when you're not calling the show is to go to talkingrealmoney.com and then hit the contact form and then speak your question.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.